Now let's talk about account receivables. Account receivable is contract asset incurred. So the problem with account receivables, there's a risk, right? Some customers may not pay. So the company should establish credit policies to determine who can receive credit. Okay. So the GAAP requires companies to establish dollar amount of uncollectible accounts for financial reporting purposes. In other words, we cannot wait until the risk occurs. Okay, we're going to estimate in the potential of collectability of those risky accounts receivable and record it before the uncollectability occurs. Accounts receivables are reported on the balance sheet as net realizable value. Okay, net realizable value. In other words, the uncollectible amount has been removed on the balance sheet. So if we look at Amazon's presentation of the accounts receivables net, right? It's 32 billion. In the footnote, it's going to disclose more information. How do we have the 32 billion? That's 33, almost 34 billion gross accounts receivable, less the reserve for bad debt or allowance for doubt account. It's almost $1 billion. So what is this allowance for doubt account? This is a contra asset account representing the amount the company expects that its customer will not pay. A contra asset account is going to reduce our asset, but it's still an asset. So if the normal balance for asset is on the debit side, and the normal balance for contra asset will be on the credit side. So how do we estimate the allowance for uncollectible account? Generally speaking, the longer past due accounts receivable is, the more likely it is to be uncollectible. So the more longer past due accounts receivable we have, the larger the allowance for uncollectible account we should have. So one method we use is the aging accounts receivable analysis. Typically, we're going to classify our accounts receivable based on age. Okay, and we're going to provide the estimate of uncollectible amount based on their age. For example, in the current account receivable, the estimated uncollectible amount is lower, only 1%, and based on which we're going to build a 410 reserve, the allowance we need for that part for any due date 1 to 60 days past due. That's 3% will be applied for uncollectible amount. And over 90-day past due, the uncollectible amount increased to 11%. Okay, so this is added together. This is going to give us $3,070. The allowance account it should have. So that's the aging of accounts receivable. And for banks, we also have the similar calculation. That is, we're gonna, for banks, we're gonna have the loan loss provision. All the loans, bank is gonna build a reserve for uncollectible amount. That's called a loan loss provision. Okay, if it's a current, the uncollectible rate will be really low. However, if it's overdue for 90 days, I believe for most banks, they're going to apply a 100% uncollectible, okay, rate for any loans over 90 days past due. So that's how we have the loan loss provision. But it varies banks to banks, right? Some banks have more aggressive rate, some banks have more conservative rate, so that's different. Okay, another method is percentage of sales method. So the uncollectible amount will be calculated as a percentage of current credit sales. For example, if we have applied 2.3% on current credit sales, we're going to have the $3,588, okay, will be recorded as bad debt expense. At the same time, we're going to increase the loan loss provision, the allowance for bad debt account. So importantly, journal entry. We start with credit sales, for example, 560 credit sales. So debit account receivable credit sales. We know that. Next, we're gonna record the bad debt expense and the allowance for uncollectible account. First, based on the analysis, we determine that the age analysis, we determine that uncollectible amount will be $3,070. This can be either from the aging method or the percentage of sales example method. The journal entries is we can increase expense. We debit bad debt expense. We credit the contra asset account allowance for uncollectible amount. That's it. Write off. When the bad debt actually occurs, we're going to write off the account receivable. Okay, writing off account receivable involves no expense, no loss. Okay, what we do is we're going to remove the allowance for uncollectible account, debit allowance for uncollectible account, and we credit account receivable. Okay, there's no expense incurred in this process. This is the effect of write-off on balance sheet. Before write-off, gross account receivables, we have the allowance, so the net amount reported on the balance sheet, $95,130. Next, we're going to write off involving reducing accounts receivables and also reducing the allowance account, because allowance account is a negative number, contra asset account, so we're going to add a positive number here. The result is we're going to have the same amount of net account receivable after write-off. So the write-off does not affect the net account receivable presented on balance sheet. So account receivable usually is well disclosed by companies. We can also find information about the pledging and factoring of receivables. Pledging means the company used receivables as collateral for a loan that will be disclosed, and the short-term loan information can be identified as well. And factoring means companies selling receivables, and the receivables will be removed from the balance sheet. It is sold. And experience tells us that many companies are using the allowance for uncollectible account to shift income from one period to another, and that can be easily done And this reserve or the allowance account can be viewed as a cookie jar. Okay. For example, in good years, year 1 in good years, the bad debt expense can be overestimated. So we can build a large cookie jar in year 1. Then in year 2, when the profitability decreased in year 2, okay, the company can book less bad debt expense. So the company can reduce the cookie jar, reduce reserve account to release profit in year 2. So the company successfully shifted income from year 1 to year 2. And in many cases, they shift income to achieve smoothed income through years. Because nobody like bumpy profitability, right? So the profitability should be consistent. Earnings should be smooth. Auditors also examined the allowance account carefully, and the policies and changes in allowance account is often discussed in companies' MD&A section in their annual report. Of course, it must be reviewed by auditors. So from there, we're going to find many information. What are the changes? If there's a significant change in the allowance for bad debt, right? We need to look carefully whether that's kind of shifting income behavior. Okay. Here we have comparisons of the allowance to gross receivables, basically the percentage of the allowance, right, among the 4 companies. So a few questions we can ask: does the company, does the company has adequate allowance for uncollectible account? But does the change in those percentage reflect the company's improvement, right, in their collection of accounts receivable, or improvement of their customers? So those are questions we can ask. And here we have some related ratio analysis for accounts receivable analysis. First, we have accounts receivable turnover. Okay, accounts receivable turnover is sales revenue divided by average accounts receivables. Right, the higher the ratios, more efficient companies collecting accounts receivables from customers. So here we have comparisons among various companies. Although I won't call them competitors because they may have different business models. The high receivable turnover implies amounts are collected more quickly. I think Walgreens and CVS can be comparables. See, Walgreens much higher than CVS, meaning more efficient in their accounts receivable collections. Also, you can compare PepsiCo to Coca-Cola, and those are direct comparables. A related analysis will be average collection period related to the receivable turnover ratio. In this case, that's average account receivable, right? And it's actually the average accounts receivable divided by average daily sales. Or an easy way to do that is 365 days divided by accounts receivable turnover. Remember, the previous turnover is 4.65. 365 days divided by 4.65 equals almost 78 days. So in this case, company collects accounts receivable every 78 days on average. And the shorter the average collection period, the more efficient it deals with accounts receivables. From those ratios, we can ask many questions, get insight into company's receivable quality. For example, we observe the turnover is lower, so we're gonna investigate what happened, why turnover is low. Right? It's possible that the collectability may have been deteriorated, right? Or it's possible the seller may have extended its credit terms, so giving customers longer term to pay. Or the seller may accepting customers who is only willing to pay on a long-term basis. That's possible. In those cases, the collection, the receivable quality will be lower. When you are asking customers, giving them more time to pay, or accepting customers who's only to pay after 2 months or after 6 months, okay, it is because you try to save your revenues. It happens when revenues decreased significantly. In this case, okay, you're gonna lose your credit sale policies and allowing customers to pay later. It may help, but on the long run, okay, the profit is going to decrease again. When you are accepting low quality customers, okay, from a long-term perspective, it's going to hurt company. It's going to hurt company even if you have provided services, goods, okay, and many of them will not make payment. Right, so the final topic is earnings management. Earnings management occurred when managers use discretions to try to hide information about their actual economic performance. There are two motives for earnings management. Right? One motive is they try to mislead the financial statement users about the performance of the company in order to gain economic advantages, for example, higher salaries or bonuses. Okay, the second motive is they try to influence legal contract that uses reported accounting numbers to specify contractual obligations and outcomes. Right? In either cases, right? Its motive is to gain something. So what are the typical tactics for earnings management? Well, we can have transaction timing. Right? We're going to book revenues in time we need. That's about transaction timing. So we have several examples. First, we have the optimistic or pessimistic estimate. Right, for example, just to talk about the percentage for applied to get the allowance for that account, right? If we can shift income from good years to bad years. So in good years, we can have really large okay, large percentage, so pessimistic estimate, then in bad years we're gonna have lower allowance, so optimistic estimate. So this is gonna give us shift income from one period to the other. You can do the same thing for many other estimates like depreciation, right? Depends on a lot of the estimate, including the useful life estimate, right? Salvage value estimate, and then the depreciation percentage estimate. Okay, those can also be, all these can be manipulated. Okay, and the optimistic estimate is going to give us lower depreciation expense or higher net income. Next example is channel stuffing. Right? When a company has its market power over customers, it's going to induce them to purchase more goods than necessary to meet immediate need. Usually it occurred immediately before the end of the seller's accounting period. Okay, if you are about to miss a sales target, okay, you can call your distributor, okay, right away, asking them to sign more contract with you, to buy more stuff with you with huge discount, okay. So this is a channel stuffing, and some of them will come to buy a lot from you. It's going to boost your revenues immediately. However, on the long-term basis, the channel stuffing is going to hurt companies' long-term performance. Right, for example, the next few periods, right? Your revenue will drop because distributors do not need as many products as they usually need because they have enough. And timing of measuring gains and losses is also important, especially for non-recurring gains and losses. For example, there's a term called big bass. It occurs when management reports a huge loss from a non-recurring items. Okay, and the big bass usually is used by management to depress income. Example, company can record a huge loss from restructuring, and that we call a big bass usually after the company replaced its CEOs. Okay, typically for new CEOs there will be restructure, and there's a huge loss. They can always blend their loss to the previous CEOs. Okay, the benefit of taking big bass is after the company take big bass, okay, they can start to benefit from the huge loss because any penny you earn after that, okay, belongs to the new CEOs, and usually it's going to be easy for the new CEO to book profit because they have dropped all the bad things already in the big bass. Okay, other considerations we have to analyze when the transactions is arm's length transactions. Sometimes some sales terms are disguised, or even it's not a sale at all. For example, the buyer is related party. Okay, so you can sign as many sales contracts with your related parties to boost revenues, but it doesn't help because very likely the two parties is going to sign buyback agreement. For example, you can ask a friend to purchase something from you in order to boost your this month's sales, but you agree to buy back those products the next month. So that's called a buyback agreement. It does not increase company sales, and it shouldn't be recorded as sales at all. And sometimes the seller is going to provide financing or guarantee the purchase by the seller. guarantee the purchase for the customer. Okay, in this case, it's also risky because if customer does not pay, okay, the seller is going to suffer eventually because they have guaranteed for the transaction. So what is quality of earnings? It is described the extent to which reported income reflects underlying economic performance of a company. And the quality of earnings can be measured in a variety of ways. Basically, if we have an earning that comes with cash payment, okay, we're going to view it as high quality earnings because if you have earnings that comes with many of the credit sales, okay, and it's a low quality earnings, very likely, because on the long run basis, the amount of earnings recorded should equal the amount of cash received from operations. Okay, those two are related. If earnings are not related to cash from operations on a long-term basis, for sure it's a low quality earnings, and very likely there's some fraud. Okay, and quality of earnings is often compromised by earnings management, for example, influenced by income shifting from one period to the other. In this case, although on a long-term basis, income shifting does not affect the relation between earnings and cash flow on a long-term basis, however, if income shifting cannot be maintained, one day the company can no longer shift income because there's some changes in company's fundamental operations, then it will have big issues. One example is the General Electric. It is reported that the company has been shifting income or smooth income for many decades. And then we see what happened in recent years when they had a big management changes, right? Market changes. The company can no longer shift income anymore. They cannot smooth income anymore. What happened is their stock price dropped more than 50%, and the company is eliminating its dividend payment to shareholders, and the business was in a mess. Okay, and finally, that's non-recurring items. I think we talk about non-recurring items, and that typically we have restructuring charges and discontinued operations, and these discontinued operations will be reported net of tax effect. Okay, and that's it, right?